So we sit and we wait and we're patient and we get the top edges. We get the opportunity to play into the top edges. And from that trade, you can see that we are absolutely annihilating it. And we've started this conversation at the beginning of 4 o'clock when we started this classroom. The conversation has driven us into this spectacular short sell. This trade that we knew had tail risk showing up in buckets. This trade that had the price of volatility showing up in buckets. This trade that had real money trading showing up in buckets. This trade that had pretty much everything we could ever want from a good trade, plus obviously the order flow elements that started to make it that little cheeky bit better. Credit risk, which I warned you about, was my biggest concern about today's top edges, has turned out to be my biggest concern about today's top edges. Credit risk was then joined by tail risk. Now I have got a lot of concerns, massive amounts of concerns about top edges. And we were right. The sell at 400 has now traded 340. The trade has now gone for over $1,200 profit on the last short sell. And we knew exactly what price to sell at because of the sellers on the delta. We knew that the only price we could sell at is top edge prices. That's allowed us to top tick the market, not bottom tick the market, top tick the market, get the exact right price and trade accordingly. This is what we call benchmarking. The higher you set your benchmark, the less number of trades you'll get, but the trade quality is going to be through the roof. And obviously, if you get less trades, there's always a chance that you might get a little bit bored and you might start lowering your benchmark a little bit. And sometimes that's okay, but at least you know that you're dropping the benchmark a little bit to get a little bit more business done. At least you know what the narrative is, and at least you know what the business that you're trying to get done is now getting done. You're taking the right trades with the right order flow, with the right narrative, at the right prices. That is called professional trading, guys. We're going to finish off at that today, guys. I know it's only an hour and a half, but that's us. We wanted to make sure this was a little bit shorter to finish off all the various lines that we use. And then tomorrow, we're going to obviously be looking again at putting all those elements together to finish off the workshop classrooms. So hope that again was of interest. Let's just recap the things that we covered in today's classroom. In order, we covered the real economy, the real money sector economy, which is the Russell Index, the IWM or RTY. We also covered credit spreads. We talked about this using HYG against bonds. The credit spread market reflects market risk, economic risk to the marketplace. We then asked you to understand our definition of tail risk. And by understanding our definition of tail risk, we referred to the Federal Reserve Board, where they actually talked about tail risk in light of VVIX. It actually even said in their own paper that tail risk is a measure of VVIX, as measured by the VVIX index. We established that tail risk equals skew by understanding that the bigger the bubble to the left-hand side, the more bearish skew we have. The bigger the bubble to the right-hand side, the more bullish skew we have. This is a very powerful piece of information. When it lines up with everything else, our trades are almost unbeatable statistically. You're on the right trade, at the right price, with the right edge, and this is what a real edge looks like, guys. This is what real trading looks like. This is why professionals can make money, because we know this stuff. This trade was called live in the room. You saw it for yourself, and it's gone on to make $1,200 profit per contract. That's the difference. Anyhow, have a good one. I'll see you guys tomorrow. In the meantime, I'm going to say adios amigos, arrivederci, auf Wiedersehen, sayonara, tutsins, tax godo, dos vidania, and skål!